Okay, before we begin, a few housekeeping notes. If you have a question, you can use the Q&A box below, or you can email us at info@mfinancial.us. The address is up on the screen there. If you miss any part of the presentation, a replay will be made available and we'll send it to all the attendees in the next few days. With that, I'll turn it over to our first speaker, Ed Garuda.
Thank you, Jennifer, and thank you everyone for joining us today. We are M Financial Planning Services, a financial planning firm located in Marlton, New Jersey. We specialize in comprehensive financial planning, and our goal is to help you move toward achieving your most important business and personal goals. In today's presentation, we're going to take some time and talk about how important it can be to understand what drives our actions when it comes to investing. The world is a different place today than it was just last year. What will the future bring? Will the vaccines mean an end to the pandemic? When will schools and work and shopping get back to normal? There's still a lot of worry and uncertainty right now about the virus and its ultimate effect on us and our lives. We worry about the health of our friends and family and are uncertain what this may mean for our jobs, the economy, and our finances. But when it comes to investing, it is important to try our best to separate our emotions from our decision making, as hard as that may be. When external factors around us are rough, it can enhance the fear of loss that we naturally have with our investments internally. All of the media we're constantly bombarded with now doesn't help and is typically even the cause of that feeling. But the way you behave as an investor can have a big impact on your financial outcomes. Today, we are going to walk through some of the common mistakes that investors can make when they mix their emotions with their decision making. And we'll also talk about how we can prevent that. Okay, let's start with this conversation with a poll. If you had to put your money in one investment today, which one would you choose? Well, studies have shown that investors are most likely to pick the pink graph. As human beings, we are wired to be drawn to reward and fearful of risk. We like this steady and sure growth for our money. If we had a choice, we would choose this investment every time. Now, let's take a look at what those investments are. Orange represents Pfizer stock. Green is the S&P 500 index. Yellow represents U.S. Treasury bills. And pink represents Fairfield Century. Does anyone know what Fairfield Century is? How about, has anybody heard of Bernie Madoff? Well, Fairfield Century was the feeder fund to Bernie Madoff's investment firm. The one investment that went up with seemingly no risk turned out to be one of the biggest frauds in United States history. History has shown that there are no magic bullets. Investing involves risk, and as human beings, it can be tough to manage our emotions when markets go up or go down. Today's presentation will help us recognize our emotions, explain why those emotions can affect your money, and how to work with your financial advisor to put you in the best position to meet your financial goals. When it comes to investing, most of us immediately think of different investments that we can pick. We ask ourselves, which stock will make me the most money this year? What can I invest in that will reduce my taxes? Essentially, what we really want to know is, what portfolio do I need to create to reach my goals? But investment success doesn't begin with our portfolio. Even the ideal, hypothetically perfect investment strategy will fail if its owner keeps making changes to it. As this triangle shows, investor behavior can be the most impactful factor to your bottom line. We've all heard of Isaac Newton. He was a very smart man, developed a theory of gravity, the laws of motion, new math, calculus. In 1720, far before Bernie Madoff and far before Bitcoin, Sir Isaac Newton lost 20,000 pounds or more than $3 million in today's money by investing in the South Sea Company. There's more to the story, though. He had actually earned close to $1 million from the same stock a few months earlier, but he bought back in after the stock skyrocketed, thinking he was missing out, eventually leading to his tremendous losses. Newton concluded he could calculate the motions of the heavenly bodies, but not the madness of the people. The big takeaway, as Warren Buffett said, we don't have to be smarter than the rest. We have to be more disciplined than the rest. So let's talk about the psychology of investing and how to build that discipline. By understanding the psychological factors of behavioral finance, we can better understand why investors often make buy-sell decisions that contradict investment best practices and rational investing. More importantly, by understanding common investor behaviors that lead us astray, we can learn how to recognize and avoid these tendencies. I'm going to talk a little bit about envy. Anthony will cover loss, and then Ted will give us some thoughts on building discipline. Envy, fear of missing out or regret of what might have been, and loss, losing money, feel twice as bad as gains feel good, are common investing challenges that prevent average investors from becoming ideal investors. This presentation will illustrate those common behavioral biases and show how to implement disciplined strategies for you to use with your advisors to inspire a smoother, more disciplined approach to investing. First, we'll start with envy. Envy is that emotion that gets us thinking, what if? Also known as FOMO, the fear of missing out. The fact that most people regret what could have been can be very damaging if that starts to take over their emotions, affecting their thoughts about their investment plan. Rational people would regret only bad final outcomes, but most people regret what could have been. A study looked at Olympic medal winners and found that bronze medal winners were happier than silver medal winners. Why? Well, a silver medalist likely thinks about how close they were to reaching gold. A bronze medalist, though, might imagine how close he or she was to not receiving any medal at all. Depending on the alternative, a person feels either relief or regret. While relief is a positive emotion, regret can be a painful and bitter experience. While you might not stand on a podium anytime soon, the reactions of the medal winners gives us insight into a universal truth. Happiness is relative. In an ideal world, we need to imagine the regret we would feel if we had an emergency but didn't have the savings to cover it. But that can be hard to do. During the 11-year bull market that ended last March, investors looked at their portfolios often versus U.S. stocks, and we call this S&P envy. If you look over time from 2002 or from 2000 to 2002, the S&P 500 was down 37%. Diversified portfolio was down about 16.3%, but investors said, gee, I lost money. 2003 to 2007, the S&P 500 was up 82.9%. A diversified portfolio was up 73.8%. And investors looked at it and said, gee, I don't think I made, or I don't feel like I made as much money. 2008, same story. Market was down 37%. Investors down 24% in their diversified portfolios. Once again, feeling, hey, I lost money. And then from 2009 to 19, the S&P 500 was up 351%. A diversified portfolio was up about 191%. It's difficult to own. It feels like you're maybe not getting ahead. You may have a feeling of regret, but in the end, they both generated the same type of overall return, about 215%. So another facet of envy is most people will tell you that buying a lottery ticket is a poor plan for financial success. But why are we willing to play even when we know the odds aren't in our favor? We are often willing to accept a high probability of poor returns for a small chance of earning a large return. This is often called the lottery effect. This is also why investors are willing to concentrate positions in single issue stocks or invest in the next hot startup company or investment trend. The excitement of the potential of large returns can cloud our better judgment, and we make decisions that reduce our overall chances for success. We can run into serious risks when we get caught in the lottery effect. If you succumb to S&P 500 envy and started stock picking individual stocks, there was nearly a 40% for each chance for each stock you picked to have lost money from 2015 to 2019. Whereas if you invested in a basket of securities like a mutual fund or an exchange traded fund, only 1% of those funds lost money over the same 5-year period. Now to talk a little bit about loss, I'll pass it over to Anthony Massaro.
All right, great. Thanks, Ed. So if you're not suffering from envy, good job. You're probably constantly trying to minimize your losses. So on the other side of the spectrum, people will do irrational things many times to try to avoid losing things. This is where we run into that loss. The overwhelming fear of losing your money can be just as harmful as not fearing it enough. And sometimes it can feel even worse. In fact, studies have shown that pain of losing is actually twice as strong as the joy of winning. When things are already looking rough, it can enhance the fear of loss that we naturally already have within our investments. If we give into it, we may start to wonder what the worst case scenario may look like. Now, a perfect example of this is a goalkeeper and during a penalty kick. So all of us really have a natural tendency to take action and try to fix our problems. Now, to take control rather than doing nothing. But sometimes taking action in these times really isn't the best solution. And this is a perfect example that you see here with the goalkeeper and the penalty kick. So if you imagine yourself as a goalkeeper in soccer, studies have shown that statistically speaking, you're more likely to stop this penalty kick by staying right in the middle versus trying to move left or right. Now, that's not always saying you should stay in the middle, but oftentimes you're emotionally geared to try to fix or do something when we're feeling anxious. And this is really what we call behavioralists call action bias, or thinking that the value can only be realized through action or the tendency to act as opposed to practicing restraint. Taking action or trying to fix your investment portfolio often lead investors to try into what we call time the market. This graph will just show you the difference in the best 5 days of the market, 15 days in the market, 25 days in the market, and missing those potential days in the market and how it may impact your overall portfolio. So if you see here on the graph, we'll show just missing just the best 5 days of overall best performing markets over the past 20 years could have cost your portfolio over $100,000. That's nearly a third of its potential value. Now, if you were unfortunate enough to miss the best 25 days, you'd actually have less money than you started with. A reality to consider is that 24 out of the best 25 days in the market came within 1 month after the 25 worst days in the market. So overreacting on any one bad day, and you could truly miss out. And the story here really is, don't let your fear of loss drive your investment decisions. Since we can't predict when the best days will be, staying invested is often the best strategy. And I'm sure, as you all heard before, it's not about timing the market, it's about time in the market. So on another chart here, we'll kind of discuss more about the fear regarding investing and when we say it might be the right time to invest, but how that could dramatically change the overall investment performance of your portfolio over time as well. So when we look at this, many investors may say that are sideline sitters, hey, I want to stay in cash because I don't want to change any of my investments right now. The stock market's done so well, it's hitting all new highs. I'll wait for a better time to get in. But there really is no best time to invest. And instead, the most important thing is to get in sooner rather than later and let that time horizon help benefit your portfolio over the long run. In this hypothetical example we're showing here, where your money grows at 10% each year, the difference between investing for 10 years versus 5 years isn't just 100% more in gains, it'd actually be 261% more. That's almost 3 times the portfolio. And a smart man once said, named Albert Einstein, that compound interest is the 8th wonder of the world. He who understands it earns it, and he who doesn't pays it. Now, when you're in for the long term, though, it's important that you realize just how much influence the market can have over you. We as humans are social creatures. There's a comfort in crowds, and this is something we call herd behavior. This can cause investors to buy investments they would have never considered. In fact, following the crowds can also lead investors to chase strong past performance. I think we can think of a couple examples just this year. Maybe you heard of GameStop or AMC. People pile into these markets when they're doing really well, and these stocks are doing really well, and they see everyone else doing it. This chart just shows an equity mutual fund flows and the performance of the S&P 500. It essentially represents how much money is invested in conjunction with the performance of the stock market overall. So as you can see, in the upturns, gradually investors began dipping their toes in. Eventually, others catch on and invest more into the market. The herd follows this behavior and the fund flows turn positive. When investors herd, they are starting to chase that performance. They're trying to invest when they know that the upturns are coming through, and they're pulling out of the market, though, when they realize that they're in the downturns. But what ends up really happening here is investors will end up buying high and selling low. The complete opposite of really what you want to do when it comes to the market. So by trying to time the market, that is what you're realizing when you're buying high and selling low. And in fact, what we end up seeing a lot of times is the performance in an upturn in the market is also strongest in the beginning. And this is what investors normally will miss. One quote we always love to quote is Warren Buffett, smart, very, very smart investor here, is be fearful when others are greedy and be greedy when others are fearful. And now it may seem counterintuitive, but it can be truly helpful at times to take this contrarian approach. And this was especially true before and after the financial crisis. Investors lost as they rode the highs of the market in 2000 and pulled out of the markets during the depths of the crisis and uncertainty, but potentially missed out on a historical bull run that happened after that. Now, I'm going to turn it over to my father, Ted, to talk a little more about building discipline.
Thank you, Anthony, and thank you everyone who's joining us today. We hope you find this information worthwhile. One of the other aspects of long-term investment planning is building discipline. Whether you're an athlete, an investor, or just in basic life, we all know that discipline has a key role in our success. Sometimes we get lost even ourselves in our emotions. If we go one way, we get too aggressive and risk-taking, we can really harm ourselves. At the same time, it's just as easy and just as harmful to be too conservative. That just leaves a very, very narrow, disciplined middle ground for us to navigate. So let's explore why it's important to be disciplined and what we can do to get there. First, let me say that you don't want to try this at home. As we've already established, investor behavior is often illogical and based on emotion, which means that it's hard for people to find that middle ground approach that is so ideal. Compounding the problem, we don't even know that we're acting emotionally the majority of the time that we are. Experts typically suggest that when you're trying to break a bad habit, it's extremely helpful to tell someone else so that they hold you accountable. They can help you be disciplined and stay on schedule when you feel like you're deviating. When it comes to investing, one of the most perfect, appropriate people to consider is your financial advisor. Many people think that an advisor might be just a money manager. In fact, they're there not only to work with you and your money, but they're also there to keep you on track, to identify the stopgap, keep you between switching in and out of your investments. In reality, a financial professional's job is not to worry just exclusively about your investments, but to guide you through the wealth building process by helping you avoid common mistakes. Obviously, last year was a perfect example. In March, for the 27th time, we probably heard the world coming to an end. Obviously, by June, everyone was euphorically saying, why did I get out of the market? The important thing to do is to stick with a plan, and that will get you your best chance to reach your goal. There was a Nobel laureate psychologist, an economist named Daniel Kahneman. His statement was, financial advising is like prescriptive activity whose main objective should be to guide investors to make decisions that serve their best interest. Working with a financial advisor can help to make the emotional roller coaster ride of the markets a little smoother with less volatile internally. That's the power of preparation and work, and also the power of discipline. You can talk with your financial advisor about creating a financial plan and investment strategy, and the plan will help dictate your investment strategy going forward. The way you and your emotions start to influence those guidelines can help be followed by stopping you make impulsive decisions. One of the greatest value investors of all time, Benjamin Graham, who was Warren Buffett used as his mentor, would indeed say that investors' chief problem and even his worst enemy was likely himself. As we mentioned, no one can predict what will happen next in the markets, not even the experts, analysts on Wall Street and TV. In a survey, only 43% correctly predicted when interest rates would go up or down. That's less than a chance of getting the flip of a coin correct. We can't control the future, only ourselves and how prepared we are. So turn off the TV, or at least put it on mute, so you're not skewed by what you're being told on these informational channels. As Yogi Berra once said, it's tough to make predictions, especially the ones about the future. So let's recap if we can. Recognize these common mistakes and the tendency to repeat them. Be willing to be critical, even when times are good, and opportunistic when times are bad. Investing for the long term. Don't try to time the market. Market history has proven many times over that even the most wealthiest investors have lost substantial amounts of assets over time by trying to time various markets. Work with a financial professional to keep you in check and ensure that you're staying on track. Create an investment strategy, a financial plan that outlines how much you're willing to lose and understand how much risk you are taking in your portfolios to make sure that your buy-sell decisions make sense. Working with a financial advisor to keep you in check and ensure you're reacting as rationally as possible. In the end, how we behave has a huge impact on how our portfolios behave. And oftentimes, the more we try to step in, the worse we make it. Work to mitigate the impact of your emotions have on your investments so that you can save time for those that really matter, which are the people that are most important to you. And if recent events have reminded us of anything, it truly is that our friends and family are our most important in consideration. At this time, I'd like to again summarize that we'll have time for questions if anyone wants to chime in with a question or two. We also have available to you the access to a link to send us questions if you want to send them directly. We'll also provide a replay of this if you want additional information about certain topics on this presentation today. What we have up here now is our second opinion service. For those of you that may not be an existing client, we would welcome the opportunity to give you a second opinion as to where your financial situation may presently be and how much risk you are taking. I'd like to open it now to questions if we have any. Jennifer?
We do. Our first question is, how do I know what investment allocation is right for me?
Anthony, you want to take that?
Yeah, I'll take that one. So, when you're looking at your investment allocation, I think all of us really start with, first and foremost, what is your time horizon and investment objective? What is your goal with that money? If it's for retirement money, longer term, you may want to be a little more aggressive with that type of said portfolio. But along with all of this, you have to assess and understand your own risk tolerance. And understanding that risk tolerance is really understanding what you're comfortable with in your own risk reward. That's something we do here with all of our clients at least once a year, helping them to say, okay, based upon your comfortability and your risk tolerance, we assess you and basically give you a risk score. It's 1 to 100. Basically, we call it a speed limit, how fast or slow you're willing to have your portfolio go for you. And with that, you get an overall risk reward ratio that's going to show you what your risk score says about how much, in returns or reward you're willing to take on for the amount of risk you're also taking on with your portfolio as well. So that's something that we help a lot of people with. And I would recommend, if you are interested in assessing your own risk tolerance and the risk of your own current portfolio, something we could help you do as well.
Our next question, how do you work with a married couple who has different investor attitudes? For example, my wife is much more conservative with her investments than I am.
Ed?
Muted, Ed.
Ed, you're on mute.
Well,
There you go. Got you now.
We would certainly take the risk tolerance of a couple when they're different into account, and we could put the more conservative person into a more conservative portfolio that would have less equity holdings and more bonds and alternatives. And as long as we were moving towards the same goals together, I think that works out fine. One of the other things I wanted to mention that we do with these portfolios is we do periodically rebalance them. So for a conservative person, if because of the appreciation of the stock market, their portfolio becomes a little more aggressive than they might feel comfortable with, we can rebalance that portfolio and get them back in line with their risk tolerance. So
I'd also reiterate too that education is probably the best teacher of long-term discipline. The better you understand the financial markets, the better you understand how markets work over long periods of time. And as long as you're keeping those monies that are appropriate in the appropriate places, you're not going to be disappointed. That is, if your investment money is investment money for 15, 20 years into the future, you can obviously have a much longer time tolerance policy than you would have for money you may need in the next 3 to 5 years. And of course, working with spouses, we've had more than our share that would say, well, can't I just mute the other spouse? And that doesn't work. So it's a team event. And I would say that the better you two spouses can work together, the better it's a win-win for everyone involved. Jennifer, any other questions?
Looks like we have time for one more. I have a few stocks that I consider myself loyal to. How can I be sure they still belong in my portfolio and they aren't just sticking around, keeping them because I'm so familiar with them?
Yeah, one of the few benefits of being 44 years in the industry is I've had a fair share of clients over the years that have had what we call concentrated positions or stocks that can never lose. For those of you that are old enough, you can remember a small company by the name of GE. We all know the outcome of GE today. But then in the 90s, when I would see retired individuals that had spent 30, 40 years at GE, you would never get them to sell their GE position because they believed it was a company that could never lose money. It was the best place to be. And obviously, unfortunately, we know that what transpired there over the last 10 years. This partiality to individual companies is never good. And actually, it increases your risk dramatically. For example, it's common for us to see where an individual will have his 401k, he'll be employed at this company, he'll also have part of his 401k invested in the company's stock. So in effect, you're not only your employment's dependent on this company, but part of your retirement plan is dependent on the company. And there are a number of other situations over the years that we could identify easily that unfortunately having the loyalty to a specific company over a long period of time can be a very disappointing experience. It doesn't necessarily mean you have to completely dissolve yourself of it, but you should make it a smaller allocation relative to the big pie.
Okay, looks like that's it for questions. I am going to take a moment to just share something on the website that I think would be useful for our attendees today. We just happened to post a blog today, our website, mfinancialplanningservices.com, in our blog right here. We have a blog post today, tips to keep emotions and investing separate. So continuing on the same theme, if you're interested, I suggest you go check that out. And then while we're here, Ted mentioned that we offer the second opinion service to anyone who might find that useful in their situation. On our website, under the contact tab, if you scroll down here, there are actually times where you can schedule appointments with any of the advisors that you heard today. So we are here and willing and able to help. And we hope to speak to you soon. Yeah, thank you. So I'm just going to toggle back to the presentation, if you bear with me for a second. And for our closing, I just want to say thank you for joining us today. We appreciate you spending the time with us. And thank you to Ed, Anthony, and Ted. If we didn't get to your questions, we'll follow up with you offline, and you can also email us and we'll respond to you directly. Thanks a lot, everyone. Have a great day.
Thank you.
Thank you.